Ladies and gentlemen, welcome to today's webinar. It's 2 p.m. here in Central Europe, so we are going to start. Today's webinar is focusing on oil and gas and petrochem market outlook. For those who have been with us already, it will remind them of the first webinar we organized in March. Here, the idea is to focus on the market outlook of oil and gas and petrochem and to give you an update about the webinar we already organized, with all the things happening on the first 6 months of the year 2021. And as you will see, we have a lot to say. My name is Jean-Charles Guilhem. I'll be your host today, and I'll be presenting with Jean-Charles that I'm going to present in a few seconds. If we're going to the next slide, just a piece of information. The first information is, of course, the information about our next webinar. It will take place on the 21st of September, same timing. So depending where you are on the planet, that will be 2 p.m. for Central Europe. This webinar will be dedicated to carbon capture. We'll discuss the technologies, but also the market outlook, because as we did the exercise for hydrogen a month ago, carbon capture is a new, let's say, process and a new industry to be developed. And of course, it's really important to get the best opportunity from this market. So in September, we really try to take an hour to expose all the facets and all the aspects of this topic. You can download directly here the invitation. I'll put them also in the discussion. As also, before going to the agenda, you can send us an email at the email guillemjean@wefirsconsulting.com to get the slide from today's presentation. And do not hesitate to follow us on LinkedIn, because we will also publish all the videos from this webinar. So if you want to see them again or get invited to the next webinar, you may as well follow us on our page. Now, going to the agenda. Without forecast, first we'll start by an introduction, of course, by introducing ourselves, what we do, introducing also our tool from which we are getting all our data. Our tool we call Project Smart Explorer. Many of you know already, are using it or will use it sooner or later. Then we'll talk about the market news, what is in the actuality, what are in the news, what about the petroleum demand as well. Then we'll try to talk about the market shift, the new business model trend, and of course we'll give a conclusion before going into the question part of our webinar. You can, since now already, start to ask your question directly in the Q&A section of this tool on Teams, and of course we'll take all the questions at the end. Now, going for the introduction, the idea is to, of course, introduce ourselves. So for those who do not know us, we are To Be First Consulting. We have developed a tool called Project Smart Explorer. And in fact, in the team is Jean-Charles and I. Jean-Charles is a senior, I would say, engineer of the oil and gas industry. He has more than 45 years of experience. And as you will see, he's really knowledgeable about this topic. He has been the ABB Group Vice President for oil and gas for around 10 years. And after leaving ABB, he founded To Be First Consulting, trying to help companies grow their market share in the oil and gas industry. He's also the chairman of an association from which you see the logo here, PCIC. PCIC is a non-profit association which stands for Petroleum Chemical Industry Committee, where you find all the lead electrical engineers for electrification, but also automation of the industry. So really well-connected person. Myself, Jean, working for To Be First Consulting as well, engineers, working for Siemens in oil and gas, and also now working for To Be First for this tool, Project Smart Explorer. Now going to the tool itself and the database. The idea is today we are going to present you data. Okay, we're engineers, we are not journalists. We are not here to tell you a story. We are here to give you figures. And our database works on a simple logic. It's 1,000 projects that we consider as active. Those projects are worldwide. It's let's say an updated list on a daily basis, where we find all the projects which are in pre-FEED, FEED phase, and early EPC stage for oil and gas and petrochemical. A project to enter this database has to be of investment of capex over $100 million. The idea below this capex, which will be let's say a local project. Here we really try to focus on international project with project organization. As well, those projects 6 months after the EPC contract has been awarded, they get archived from our database, but they are still valid and available. It means that when we are giving our projection about the market, we will try to focus on those 1,000 open projects. Going to the next slide, here is the focus of the database. As you may know, Project Smart Explorer was normally, let's say, at the creation, focusing only on oil and gas and petrochem, from which we are going to talk today. But we are also expanding the scope to renewable and decarbonification. As you have understood, we are focusing also on hydrogen and carbon capture. Here you have the list of all the applications we focus on now. And on the next slide, you also have the detail about the new focus we have on renewable and decarbonification, a focus we are also extending to get all the hydrogen, ammonia project, also all the carbon capture, because the energy industry, as we know it, not only the petroleum, but the whole industry is also now counting more and more on this new project, which can be interesting for many of you who are attending our webinar today. Now going to the next slide, I'm going to leave the floor to Jean-Charles this time, and he will take care to present himself and tell us about the market news and the petroleum demand. So Jean-Charles, the floor is yours. People can see you on the screen, so you can start.
Thank you, Jean, for this introduction and orchestrating this webinar again. And thank you to all of you to join it. You are more and more to join it from one session to next. So hopefully in September we'll even more people online. That would be great. But for today, as Jean mentioned, we are going to focus on this market news and market outlook at halfway of 2021. So let's start with some news, at least to show you that the view we have about the market, we are not the only one to see it, but you can find it through different messages that you can read in medias. For example, from the IEA, where it says that the global electricity demand is growing faster than renewables, driving strong increase in generation from fossil fuel. It's very explicit. Bloomberg, the same. Energy inflation, gas space has EU gas power surge to record. And Reuters as well, OPEC plus agree, oil supply boost after UAE Saudi reach compromise. So you can take it through different angles, but the demand for fossil fuel is there for a number of reasons we may address during this presentation. But that's a fact that we observe as well from our side, and we are able to qualify and quantify. First curve is a curve you may have seen already through also different form, but it shows here on the graph on the left here the comparison between the oil production and the oil demand. So in yellow you can see that of course this oil demand has dropped in April last year dramatically by 20% or more, but the production started to run anyway in the meantime, and today the recovery is pretty effective as we run at 97 million barrels per day, compared with 102 million barrels per day we had at the end of 2019 before the COVID crisis. So we are not yet at the same level. That may be something that we can expect by the end of this year or beginning of next year. But in absolute value, 97 million barrels per day is really already a pretty high level in value. That's the first conclusion we can make from the figures. The second thing is that you can see also from the bar graph here below, which reflect again through a different source, but the same thing when you see the recovery coming up, and here's the recovery to previous level is anticipated by December 2021. In the graph above is somewhere later in 2022, but okay, at least if there is something that we can take for certain, if the first wave of the COVID crisis has been affecting, of course, the world economy, the second wave and third wave have much less impact, if no impact. And if there is any fourth wave, has many indicators show it now, we can anticipate that this fourth or fifth wave, if any, would have no impact on the economy because now all the companies, governments, organizations in general have learned to live with this COVID and have adapted their organization so that the economy can continue to run. And overall, thanks to the vaccination, then the consumption is running full speed, pulling the demand on oil as well as in gas. So that's the first conclusion. Another way to see it is by region. And on this bar graph here, on pink, you have East Asia. In blue, you have Europe. In green, you have North America. And the rest of the world is in gray over here. What is interesting is, of course, the drop of the activity and the demand of oil region per region. But as you can see, it didn't happen exactly in the same time. And that's interesting because it started, of course, by East Asia because of China. And then it took about nearly 3 to 6 months to see the impact on the rest of the world. And in the meantime, China and Asia in general had started to recover, while Europe, North America, and the rest of the world were slowing down. So this difference of timing in facing this wave of COVID are damping, in fact, the consumption pretty well, and the lack of consumption, so that, in fact, we can see the recovery on month per month globally, so that today, in fact, with the difference of timing of the COVID wave in the world, in fact, we observe, and of course the adaptation of each countries, that now those waves are coming, but in fact the economy and the consumption of oil remain very stable, somewhere around 97, 98 million barrels per day. So that's something we observe through all those indicators, and which start to be now very stable, confirming the long trend now on this oil demand. Another way to measure it is on intermediate commodities. You have here in dark blue the crude oil price, and you can see, of course, those crude oil price after the collapse in April 2020 have recovered pretty fast in this year 2021. But for the intermediate commodity in green, illustrated by the price of resin, resin of polymer, which illustrates the consumption of plastic, to use a common word. In fact, we can see that the price are going to the roof for a simple reason that most of the economy have starting up again their manufacturing activities in Asia, in Europe, in North America, of course. The problem is that petrochemical and resin are the first source of supply of those manufacturing activities. And unfortunately, the response time of the facilities and plants producing those resin, those plastics, those polymers in general, is far longer than manufacturing industries. And that's where the systems start to block, because if you don't have the polymer on time, and then the manufacturing facilities are on hold, and like for ships, waiting for those resin to come in acceptable quality, quantities, and prices to make those manufacturing activities running. And that's what we observe, and why we see those prices rocketing here, illustrating the tension and the difference of speed between the demand for manufacturing good on one side, which is very high, thanks to the stimulus of the different governments, and the industry, which is, of course, restarting all those facilities, but unfortunately have a response time which is in weeks or months for some of them. Another indicator also, which is interesting to share here, is air traffic. So here on this curve, you have the comparison of 2019 in red, 2020 in blue, with a drop again in April, and then you have 2021 with the first 6 months, where you see, of course, that we are not yet at the same level of 2019, but we are significantly higher than 2020. And just for your information, we are already exceeding the air traffic we had in 2018, which is not that far from us. It's not appearing on that curve, but just to take that as a reference. And so we anticipate that the air traffic should not align with 2019 this year, but that should happen normally in 2022, because in Asia or in USA, for example, the activity of the air flight is back to normal. On Europe is still slow, and transcontinental flights are, of course, slowing down. But on a domestic flight, let's say, the traffic is pretty bad. It's pretty good, thanks to the vaccination as well here. Last indicators on to measure the evaluation of the situation is consumption of transportation fuel. So on the left, you have the jet fuel consumption. Again, the comparison between 2019, 2020, and 21. And you can see that for 2021, the forecast is to go for jet fuel somewhere halfway between 2020 and 2019, which is already showing a significant improvement. With some option of coming up even faster if the traffic can apply between intercontinent. Regarding the road fuel, then the picture is even better because many people have now left public transportation to take their private car to avoid the risk of contamination, of course, and that has an impact on the road fuel consumption, which is pretty high and should reach 2019 pretty easily before the end of the year. So that here where we see the consumption, and you can see the price of the gasoline at your pump increasing in all countries, reflecting the overall demand for gasoline and transportation fuel in general. The good news also we observed during this first quarter or first half of the year is coming from international oil companies. And you remember that in previous webinars, these international oil companies were really the operators suffered the most to this COVID crisis. They were already suffering since 2014 when the price of the barrel collapsed from under $20 to $60. That had affected their capabilities of borrowing money and investing and generating cash flow. So that's why they had reduced their capital expenditure by something like 50% since September 2014. And of course, the COVID crisis didn't help them so much in that respect. But suddenly, on first quarter 2021, you can see that the demand for oil field services is booming from these international companies, reflecting how much now those international companies feel confident on the future demand for fossil fuel. And that's very good news because those ones are suffering the most, let's say, from the crisis again. And so if these ones are now confident that the market is catching up, then that means that yes, it's a very good indicator for the future that the market will effectively continue to grow. A focus on USA because, as you know, shale oil and shale gas is quite often taken as a variable of adjustment of the demand in the market, in the global market, because that's where the production costs are higher compared to other places in the world, like Russia, like Saudi Arabia, or Middle East in general, for example, or even Asia. And so if the demand or the production is increasing in USA, that means that yes, the demand is now calling for all the extra capabilities of production to come into production to meet this booming demand. And if we compare the number of rigs between 2020 and 2021, you can see that for the gas, the percentage of is 29% in 1 year, which is already significant, even though the gas demand has remained pretty stable, but you can see that it's coming up again anyway. But for oil, of course, where we saw the hardest slowdown, then the demand and the number of rigs in operation has doubled in 1 year. As simple as that, and that illustrated by the curve you have below the table. So that's a good indicator of the situation, not only in the US but globally, and also in the confidence and of the implementation of Joe Biden plan. You know that Joe Biden in his program has promised a $2 trillion clean energy program, and we start to see the effect of this plan, even though it's of course just at the beginning or early days of implementation. The first things I would like to highlight here is that Joe Biden is of course going to invest in renewable energies for sure, but more importantly, he will invest in clean energy, which is a little bit different. Clean energy means conventional energy like oil and gas and fossil fuel, but produced in clean condition, meaning that USA cannot compromise its self-sufficiency in terms of energy, because since Barack Obama presidency, USA has become self-sufficient in energy. Okay, they don't need to import any gas or oil anymore. And Joe Biden was vice president of that time, and since then, of course, USA, whatever is a president or whoever is a president, has no intention to review this strategic position to be self-sufficient in a very competitive energy source, because it will be the preliminary condition for them to restore their economy and to relocate, more importantly, industry in USA, because of course, again, the first source of supply of any manufacturing activity, wherever it is petrochemical. So if you want to be competitive in manufacturing, you have to be competitive in petrochemical, and that's where it is critical to be competitive in producing oil and gas. But where the change is that this production of oil and conversion or transformation of fossil fuel into plastic and polymers has to be done in a clean manner today. And that's the idea of this plan, which is very interesting, because not only it will not slow down investment in USA, but it will increase in opposite way the investment to make sure that all oil and gas production and transformation will be done in a clean way. In addition, of course, to the investment on renewables such as solar and wind, for example. Okay, so many good news coming from the USA, and that will impact, of course, the global economy, and of course for the sake of the protection of the environment. Now let's focus on investment and the market more precisely now. Comparing the EPC business awarded between 2019 and 2020. So we may have seen this picture already last quarter, but just for history of the people who were not there. Here we compare in this ring with the three colors, the three categories of operators. So you have in blue the international oil companies like BP, Shell, Exxon, Total, Chevron, for example, about 10 majors. In red, you have the national oil companies like Saudi Aramco, Petronas, Petrobras, and 100 of them. And in green, you have those famous independent companies, as you may find them a lot in USA, in UK, or in Asia today. And in 2019, you can see that the market was pretty well balanced between those three categories of operators. By comparison, in 2020, you can see that the picture has significantly changed. The international company in blue have collapsed by some 60%. Okay, the volume of investment came down from 106 billion to 44 billion in terms of EPC contract awarded, so 60% below. In opposite way, the independent in green came up from 106 billion to 130 billion, so about a 30% increase. And the national oil companies came up as well from 110 to 117 billion, so about 7% increase. So overall, even if international companies have collapsed on that period, the market has not collapsed, and we observe only something like 7% decrease overall of the volume of EPC contract awarded in terms of capital expenditure. So that's a very important point to mention here, and that's why we talk about market shift, because we see the market shifting drastically from the international companies, which was representing a third of the market, to the national oil companies and the independent, taking a strong lead into the market today. And that's a very important point to realize, that all media and communication related to the international companies are reflecting the situation of those companies, of course, but it does not reflect anymore the situation and the behavior of the market. And that's the first takeaway I would recommend you to take for this presentation. Now, if we compare 2020, where we have, of course, the same figure as in the previous slide, with the first 6 months, 2021, the situation is even more interesting because you immediately catch up that the international companies continue to slow down, and to lose ground, and they represent only 10% of the market now. And at the end of the year, they may reach the same volume as last year, but not much more. But in opposite way, the independent companies are increasing their market share, or increasing, their volume, because from 130 billion for 12 months last year, they have already reached 106 billion in 6 months. So it means that we anticipate for independent companies to increase their capital expenditure by something like 50% this year. Regarding the national companies, the situation is even more significant because they come up from 117 billion in 12 months last year to 150 billion of EPC contract awarded in 6 months this year. So that means that by the end of the year, at least the national companies will easily double the volume of EPC contract awarded to contractors. So it's really a booming market. And if we compare in total on those same period, so we go up from 293 billion in 12 months last year for all operators together to 286 billion in 6 months this year. So we can anticipate that globally the market this year should increase by 50% at least between 2020 and 2021 at the end of the year. Okay, so that's where we are, and it shows how much the market continue to shift and how much dominant are now in the market, as national oil companies and independent companies as well. So now, if we look at the more detailed project, here you have the volume of the capital expenditure of the project awarded, and the forecast we see for in the history between 2015, let's say, and 2020. So we had a slow increase, and of course a short slowdown in 2020. But you can see the forecast for 2021, 22, 24, 23, 24, and as we said, for 2021 we anticipate an increase of something like at least 40%. But we also notice that the forecast for 2022 is even higher, and the visibility we have already today for 2023 and 24 are pretty high, even though, of course, there are still many projects which are not yet identified in our database, which will come on the top of what we see today, and will continue to fill in this business pipeline that you can see here. So we anticipate that for the next 5 years, the demand and the capital expenditure for project will be very strong at the image of what we see between 2020 and 2021. And in red you have the petrochemical investment, and in blue you have the oil and gas and upstream and downstream, and you can see that both are evolving on the same way. If we look where we stand, so the previous slide was a forecast for 2021 and following years. Now here we have the same graph, but not with a forecast, but with actual business awarded. And you can see that after 6 months, 2021, we are nearly at the same level of 12 months last year. Okay, so we find the confirmation of the figures you have seen on the previous picture with the rings, you know, showing the market divided by the profile of the operators. So here we try to analyze the market, how the market is behaving. And on the top of what is already awarded, you have in blue what should be awarded still this year, and in gray you have what should be postponed, because in fact what we anticipate is when you have a surge of demand from operators to award EPC contract on a so short period, there is no chance for contractors to absorb such ambition of the operators. And we see today more and more projects, especially in offshore, for example, where operators are tendering project and they have only one vendor or one contractor bidding, or no contractor bidding, no contractor at all, because the proposed conditions are not attractive. And today the market is not driven by the end users, but the market is driven by the contractors and the appetite of the contractors to go for this kind of project or this kind of project. And if some projects are proposed in too bad condition, they will not find any contractors to go for it. It's just the situation today where we see the offer dominating the market against the demand from the end users. And that's why we see the market becoming captive in red, as you can see here, because you can see for 2022, for example, that a part of the business has already been awarded, same for 2023 and 24. Reason of this is the appearance of the new business model by the end users to try to secure the capacity in the contractors. And we'll come back on that in the next slide regarding this new business model that represents today 40% of the market. And we recommend you to integrate in your strategy because it has a big impact on the bidding strategy of the contractors, but also on the pricing model of the vendors involved in those projects or who want to be involved on those projects. A quick look by geography per region of those projects. On the top, you have the split of the investment, investment in terms of capital expenditure on EPC contract awarded. Okay, so here we talk about EPC contract awarded, so actual numbers. You have in blue oil and gas here. Okay, so here we are, the color is not reflecting the profile of the operator, but it is reflecting the application. So in blue, it is oil and gas, upstream and midstream, and yes, and upstream and midstream. In red, it reflects the petrochemical from refining to all ethylene crackers and chemical specialties until fertilizers, for example. And in green, you have this new category called energy, where you find a project related to decarbonation and renewables. And so you can see that this first half of the year, oil and gas is representing 70%, petrochemical 24%, and renewables and decarbonation only 7%, which is anyway quite significant and shows the dynamism of this emerging market, which is booming at high speed, and we can anticipate that on the second half of this year, the percentage of projects awarded in this category will have more than double. Per region, so you have a color code on the right, which shows how much Asia Pacific is by far the most dynamic region in terms of sanction of EPC contract. Here we talk about the region where the projects are located. Okay, the projects are located in Asia Pacific here. The contractors being awarded may be in Asia Pacific, but they may be anywhere else as well in the world. Okay, so here we refer to the location where the project is going to be built and operated. So the second region is North America, mostly USA, by the way, and which translate or reflect the dynamism of the US economy and the speed of the recovery. And in violet, you have Middle East, which has been constantly dynamic. They didn't slow down at all in 2020, even though some project has been postponed or delayed, but overall, Middle East has remained very active, and that continue in the same way today. After that, you can see there is a gap with three other regions, which are Europe in green, South America in red, and Africa in light blue. Here you have a map of the project awarded in first half of 2021. So in green, you have the location of the project, and then in orange, red, and violet, you have the location of the contractors in charge of the FEED, the EPC, and the PMC. In blue, you have the location of the operators, which refer to their headquarters. But regarding the contractors in orange, red, and violet, it reflects the location of the office where the job is being done. So you can see that the project in green may be all over the world. Most of the project in terms of FEED or EPC are concentrated in North America, Europe, and Asia, of course. But you can see that here with this kind of tool, you can locate very accurately where the decisions are being made in the supply chain of those projects. Should you run with after those projects to capture any business out of it? Let's go back to this new business model we mentioned earlier, which is today affecting fundamentally the market. Here you have a diagram showing the comparison between the traditional business model and the new business model. The traditional business model starts with a pre-FEED, okay, the conceptual study. Then it continues with the FEED or basic design. A FEED stands for front-end engineering and design. That's a phase where operators and contractors select the specifications, they select the standards, they also select the vendors, they elaborate the vendor list. And at the end of the FEED, they organize a tender for the EPC contract. And during this tender, the contractor will submit offers. And if some of those offers are matching the budget of the operator, then the operator will be able to make the final investment decision and to allocate the contract for this EPC to the lowest bidder for this EPC contract. Okay, so you are familiar with that, I believe, and that's a normal way to work. Now we face this new business model where, in fact, the pre-FEED is the same, okay, same conceptual approach as usual. FEED is a little bit the same, but the FEED here will be done on more deeper details in this condition. And at the end of the FEED, the contractor will propose at the operator a price and delivery time to convert the FEED into EPC directly without any tender. And if the operator is comfortable with the proposal that the contractor is offering in terms of price and delivery time, he may accept to proceed to this conversion without any tender, even though the operator is not yet in position to make the final investment decision, because he's still waiting for financing, he's still waiting for securing his own market, he's maybe also waiting for permit, for example, for building up this project, and so on and so on. Okay, so it may happen between the time that the contractor and the operator convert the FEED contract into EPC contract and the time that the final investment decision is made. It may happen 6 months, 12 months, even 18 months in some cases, but at least the EPC contract is awarded. And that has a big impact, of course, in the market, because today a number of contractors who are not interested by the FEED business have understood that if they want to secure the EPC business, they have to do the FEED first. And that typically is the case of Western contractors like KBR, Fluor, for example, or in Europe, companies like Technip and Saipem, who have changed their strategy to focus on this market, to work only on reimbursable-based project or on a lump sum turnkey, but at the condition that this lump sum turnkey contract is coming from the conversion of their FEED work into EPC. But those companies are not now so much excited to tender and to compete for EPC contract in a conventional business model, because they have more than enough business to take away from the new business model. This business model has consequence for the vendors, because, of course, to convince the operator to convert the FEED contract into EPC, this contractor had to submit an attractive price. And this attractive price cannot be done only by aggregating a budgetary offer from the different vendors. okay, because of course the price of the project will not be acceptable. So they have to work with more competitive price, and that's where for the vendors, supplier, or subcontractors, they have to submit offer in a different pricing model than they use for the traditional business model. Typically, here you have the comparison between both. On the top in red, during the FEED, usually as a vendor or subcontractor, you will submit your budgetary price. Then when the EPC contract is tendered, you submit more competitive price. And when the EPC contract is awarded, finally, you submit your rock bottom price. That's the logic of the pricing model in a traditional business model. If you do this in the new business model, you have no chance as a vendor or subcontractor to be selected at FEED phase. Just forget it, because your price would be far too high. Of course, in opposite way, you are not going to submit a rock bottom price at FEED stage. Otherwise, you will lose your shirt, your margin, and your stakeholders may not be happy about the way you are running the business. So you have to adopt another type of pricing model where we recommend you to go for open book pricing. Open book pricing means that at FEED stage, you submit a more aggressive price and budgetary price, of course, but providing some condition related to specification, related to quantities, related to material costs, related to currency, related to documentation, to testing, to a number of different conditions that may affect your price between the time that you submit your price at FEED stage and the price you get the order at the EPC phase. Then here in the database, we give you all details to find out in which way the project is going on, if it is a conventional business model or a new business model. I'll not detail that here today, but if you are interested, we can make you a demo and to show you how we differentiate those projects in the database so that you can accommodate your pricing model depending on the context of the project. So in conclusion, as we anticipated already at the end of 2020, and we saw the confirmation at the first quarter, we see that the demand for oil and gas is back on track, and the investment in projects are back far above even expectation. The growth for oil and gas demand is sustainable, for sure, and we see the demand at least for the next 5 years. All forecasts for the consumption of oil are showing that it should stand around 100 million barrels per day, at least until 2030, 2040. So the question is not if we could reduce it, because nobody has any idea how to reduce this demand or this consumption. But the challenge is, of course, to make again this oil and gas production and transformation as clean as possible, so that, of course, it has no impact on the environment. So the pipeline of project will be loaded, but well loaded for the next 5 years, and most likely for the next 10 years, without any fears. And what we can notice is the quantities of new players into the market, especially using this new business model. And that may be what you should consider, especially coming from the independent companies. You see the role of those independent companies taking more and more share in the market. And that's something that you should integrate in your strategy if you want to play a role and keep a leading position in this market. Then some regions have business-wise already recovered from COVID and are pushing hard. Asia is one example, but Middle East as well. The USA another one. And for 2021, we anticipate to be something like 40% higher than 2020 or 2019. Then some projects may anyway be delayed just because of the capabilities of the contractors to absorb such a demand. But overall, again, the market is just booming at this moment and should continue on the next 2 or 3 years. So that's the way we see it. Are you ready to take advantage of that situation? And your questions are most welcome now.